As always, we will start with the disclaimer. This is not financial advice, only my own and other speakers' personal opinions. This is not to encourage nor promote taking any trades, positions, or investments of any kind. Any information contained in this conversation is for informational purposes only and to be taken as is. Derek Wong and other speakers have done their best to ensure accurate information. Regardless of anything to the contrary, nothing available in this conversation should be understood as a recommendation. Consult a licensed financial professional in your jurisdiction. This conversation will be recorded and posted for future reference. Well, today's discussion that reached the polls is technical analysis versus quantitative analysis. And I have a few things to say about it. There is definitely a gray line because some technical analysis signals can be turned into quantitative signals, but from my general viewpoint of what is technical analysis, technical analysis to me means drawing things on charts. I like to call it throwing spaghetti at the wall. As you can see, I'm highly biased against what most people would consider is technical analysis. But a book that I will mention that came out many years ago, maybe 15 years ago or so, David Aronson's book, Evidence-Based Technical Analysis, is this gray zone where transitioning from technical analysis to a more quantitative setup really impacted me when I read it in 2008 or so, 2009. So let's just start off with kind of what I'm defining as technical analysis. First off, it could be moving average, Bollinger Bands, RSI, these type of things that you click the chart, you say add indicator. It could be someone drawing something on a chart. It could be things as complicated as Elliott wave, which I'm extremely skeptical of. And it could be something like support and resistance, and a 200 period moving average, which is on that more evidence base there. That is something that can be back tested. So looking at this kind of spectrum of what is technical analysis and not. So my issues with technical analysis as proposed is, one is it's not replicatable. If I give one random chart to 10 people who tell me they can do technical analysis, you will get 10 different results. But I also find that traditional technical analysis, and I mean, I forget what it's, Nissen, analysis of candlesticks, and the traditional kind of like cup and handle or triangle wedge, this type of stuff is actually kind of a form of prediction. And what they say, if this happens, this other thing will happen. And as we know, that's an extremely difficult thing to deal with. Now, if you can imagine a wedge pattern as drawn as like a triangle, basically, it does actually affect a breakout. So how close is a, say, 200-day breakout compared to a horizontal line breakout? Again, that's kind of in this gray zone. I think that the reason why a lot of retailers and newbies come into technical analysis is because the barrier is extremely low. Anyone can open up their screen, pull up charts on whatever free charting platform, and start putting lines and believe they have a view on the market. But the issue is having a view and having an edge are two totally different things, and that will lead me into the quantitative part. So if you're doing quantitative well, it will always be evidence-based. So that is a necessary condition for something to be quantitative. It mostly looks at relationships. And by that, I mean, it could be now and to the future. It could be one thing against another thing. It's a lot broader than looking at a single asset and a chart. I mean, okay, you could do multiple time frame analysis, compare all these different things, and we can go kind of like bananas on technical analysis. But it's a single framework that allows you to analyze one thing or many things. It allows you to look at different things, derivatives of things, like the returns of something versus like the price action, while normally technical analysis is just done on price action. And I will say quantitative analysis, and then again, we're talking about this prediction aspect. Is it a type of prediction? Yes, also maybe. Okay, in my book, probably. But the difference is we're looking at distributions as opposed to a point estimate. What do I mean by that? If you have some, I think it's like 1, 2, 3, 4, 5, A, B, C, D, Elliott wave, the people will believe that the next wave should be starting some cycle. I actually don't know how Elliott wave works. I've just seen people write these numbers in letter combinations. Then this X will happen. But in a quantitative framework, we will say, okay, based on our evidence, our historical data, our statistics, we believe that the distribution, or rather, we can even make it more simple, there's a probability of something will happen, and we know roundabout, with some error, what that potential probability is. And so one is having a certainty on your analysis, and one is adding an element of uncertainty and being able to quantify that uncertainty. And that goes back to our previous clubhouse talking about risk and uncertainty. So I'm obviously an advocate for quantitative framework. I do believe that simple strategies such as momentum, such as breakouts, such as using a 200-day moving average trend filter are quantitative systems and are that bridge of the divide. As long as you are using data and using statistics and have some kind of sample size. I mean, I would rather have something that has a 10 sample size than a guy drawing some spaghetti on charts and then telling me something. I have a lot more confidence in one than the other, even if it was a low sample size. So going from like 0 sample size to 10 and knowing that if someone else ran that experiment in another country 100 years from now, they would have gotten the same result if they had the same data. And you obviously can define what that data is, makes it a lot more robust in my mind. So I will leave the floor open. And as always, please raise your hand if you would like to speak. And I hope this is a good discussion. All right. I may be having technical issues. I see Marcus has his mic on, but I can't actually hear anything.
Hey guys, I actually muted myself, unmuted now for a second just to let you know that actually my mic was off. I just joined.
Okay, well then it's not a technical issue. Thank you for that, Marcus. That great sound check. I think that this topic, of course, hit the highest rating for this week's conversation, and yet here we are. Let's talk about the journey going from technical analysis to quantitative analysis, and how some people can bridge the gap. Like I said, this book by Aronson was groundbreaking when it came out, and if you as a human could execute what I would say systematic technical analysis, again, that's kind of in that realm where you would have more consistent results, because part of the issue with doing pure technical analysis on a chart is you're inconsistent, and the inconsistency of you drawing lines on some chart and someone else drawing some lines on some chart. But if you were able to systematize what you're doing, say you only take support and resistance breakouts, you would start to approach what is a actual like classic trend following thing. If you were able to do it consistently and set your rules, you wouldn't have the same exact results as someone who's following it absolutely systematically, and you wouldn't actually know what your trade statistics are, because you would be eyeing it every time. But there would be some range of breakout, if you are doing support and resistance breakouts, that would be correlated to what you're doing, assuming you're like looking at very similar time frames. And that inconsistency could come when you draw, say, something that has two higher highs very close to each other versus two higher highs that are very far away from each other. In the systematic sense, that would be like you took a short time breakout versus a long time breakout, but in your systematic TA version, that's the same system, but for us, it would be something totally different. If you were able to backtest that somehow, then you would even more approach the quantitative side. The hurdle to breaking out of evidence-based technical analysis into what I would call pure quant is extremely high. You'll need some ability to code. You'll need some math, statistics, at least the basics. And you will need to be able to turn data into insights. What do I mean by that? You have a lot of data floating around. You'll have a lot of trade statistics, but how do you actually interpret those statistics and then follow them exactly to go from this insight that, okay, there is this thing that exists in the market, and our example is breakouts, to a repeatable edge? And then you have the hurdle between research and implementation, because it will by necessity be systematized. If it's not, then it goes into gray box land, which is something, of course, we have discussed. So there is a path to go from pure technical analysis to pure quantitative analysis. It gets fuzzy on people taking heuristics from the market. Like one great example of this is the RSI. People love to use the RSI. And they think, okay, it's oversold now, I should do something. In my research, which I conducted probably over 8-9 years ago, RSI is a horrible mean reversion estimate. It is a much better momentum indicator. When something is oversold, you do better to sell it, which is, again, counterintuitive to the design of this indicator. And people are reading the definition and like what this thing does, but it actually doesn't do what it says on the tin. And without actually doing the evidence-based part, taking this technical indicator, doing the test on it, and seeing that the relationship is not, what it says on the tin, then you have an issue. You actually have negative edge. So in the pure TA sense, if you will find a lot of this. You will find a lot of these things that claim to provide edge that are either A, untestable, or B, when tested, show something else. There's probably only 5% or 8% of something that's worth following in that space.
I've been having this conversation. Hey, good morning, guys. Good morning, Derek. I've been having this conversation for a long time. My father is a technical analyst, from back in the day. And hey, listen, he's very good at it. He's done very well for himself, and he's been teaching me really honestly since I'm 5 years old in the ways of technical analysis. And as some father-son relationships go, like we started battling in my college years between he maintains that technical analysis is an art, and my whole thesis that has driven me to where I am is that it should be a science. And I think that, and I've been silent because I've been thinking about what you said, Derek, and I'm trying to piece together my thoughts on what the differences are. And I think are you enacting rules based on these technical factors? But that's the debate I've been having for decades with my father. Is stock picking, or stock market, is trading an art or a science?
Hi to everyone. I think that maybe I might be wrong, but a few years ago, maybe 5 or 6 years ago, I watched an interview with one famous trader, and he said that there was a research that, and I don't know is it right or wrong, but I believe it, that there is no reason to be have very big involvement in technical analysis, because, for example, if we do the trade according to technical analysis signal and do the trade, it's the result of that research, and you do the trade without any reason, you will have nearly the same result. So, but I think that it's a matter of choice. If a person have these enters and exits in his system, if it's done consistently, maybe it's okay. But it's not my choice. It is also I like only to buy a breakout to sell a breakout classical transform style, and I think I am not telling anything surprising for me about my point here.
The interesting part of this discussion, and one of the reasons why I sort of let others chime in before I did, is that I find that quantitative versus technical analysis versus any kind of signal based, because that's what we're talking about, indication boils down to the nature of what how do markets function. Are they cyclical, or is there something that works differently? I do believe the markets are cyclical. I spent an awful lot of time trying to understand Elliott waves, and obviously came away thinking that I don't understand it. But the point I don't understand about Elliott waves is the fact that there seems to be some structure that the market doesn't want to follow. Not so much these waves. The waves are there, but how you measure the waves. So that got me thinking about, okay, so how do I measure a cycle? And then again, it goes back to this nature of time in trading. Is time event-based or chronological based on some sort of chronology? And my idea is that it goes back to events. So cycles in trading are there, but they have different lengths, and they have different amplitudes as well. So kind of frequency and amplitudes are constantly shifting depending on what's going on in markets. So technical analysis fails there because it's really prescriptive. It tells you this is your indicator, parameterized as 25 to whatever, but those parameters keep shifting. And the problem is not the RSI or whatever, the stochastic or whatever, however you want to call it. The problem is that you find the truth in some sort of tool that isn't absolute but is relative. And so the question we should ask ourselves is, how do we keep time in markets, and how do we spot cycles in markets?
There has been a lot of interesting points raised, so I will hit on a few of them. To Andy's point, this art to science version, I do believe that there is some correlation to probably major factors and people who can do technical analysis well. And I think that that's why I use the wedge pattern breakout support resistance trader versus to say the style of trend follower, or someone who uses momentum or a 200-day moving average. I mean, that simple thing does actually drastically change the return profile for almost anything you throw at it. And so if they are able to get something close to that with their intuitions that they've built or their mental heuristics, then by nature they are exploiting this almost similar thing. But then it just comes to how consistent are they to be able to analyze that underlying thing and repeat that. To Oleg's point, yeah, 100%. I don't believe in that. But if someone is able to get close, like you can imagine they are a trend follower using technical analysis, support and resistance breakouts, then potentially there is a way for them to become net profitable, because breakouts do have good properties, which we all know and love. To Bruno's point, this Elliott wave thing, honestly, I dig on it quite a lot. Cyclical nature and the changing of parameters. Yes and no. I mean, I think my issue with the idea that Elliott waves can show a signal is that if I drew my waves and you drew your waves, they're different. And ex post, it looks great. Like we can all draw all the perfect stuff, but like ex ante, I'm on count 3 or C or whatever it is, and then you don't know which way it's going to go. How can you discern something from that? Now, I do believe that there are cycles in the market. We know that through kind of everything, whether it's equity sector cycling, whether it's through inflationary, deflationary periods in larger macro trends that do produce certain, say, underlying flows, underlying pushing into a market. And those are variable, yes. But I mean, even if you think about like Dalio's economic machine, the large debt cycle, the business cycle, and then, things like that. I do believe that that's there, and then putting numbers on that may help, but it's very tough for me to be able to say someone consistently throughout a career draw the correct stuff, because like you said, they would have to know how to change from the short time to the long term parameter. And I mean, that's what we're trying to solve in a systematic way by having multiple systems, right? We know we don't know what those parameters are, but if you're a technical analyst, you have to know. So their ability to guess if it's the short time trend, the long time trend, or the short mean reversion or the long mean reversion, adds just this whole other type of complexity on top.
I think that we just must not be too complex here, and I like very much breakout methodology. I like it very much, and maybe it's part of technical analysis, but I do it, I like it, maybe I even love it. But if we are talking about something like buying the dips, like head and shoulders, and other figures, I think I don't see at least any reasons for me personally, as I always say, to do this. I don't see any reasons to do my system, my transforming classical system, more complex, because I will not improve, in fact. I am sure that I will not improve my transforming. Like Jerry said, that there is no way of improving the transforming, classical transforming, and I believe it. So here's my point.
Yeah, I think Oleg, you hit on something there, which is this gray line between what is a pure technical analysis breakout to what I do believe trend following is Jerry style, turtle style, whatever you want to call it, is a quantitative system. It has the properties that I'm looking for. It is on the borderline, and I think that that's why because you can put those indicators on a chart, it has the lowest barrier to entry to the space. Like people understand what is a breakout, and then like if you are able to systematize it, back test it, and come up with some trade statistic, then and execute that exactly as your system says, it has become quantitative and systematic. So I'm sure we don't need to complicate it, but there is a gap. Like you can bridge the gap, and if you were to probably test all of the potential indicators that are available on all these platforms or even free ones, there's hundreds, hundreds of these things. You could probably find a mix of them that would create a multiple system thing, or you could do even one like the channel breakout, and you would actually discover that works. So I think that's where a lot of people get caught up. It doesn't need to be complex, but the idea that you need to bridge the gap with doing your homework is another thing. And so many people on Twitter or whatever draw these beautiful charts that this is why this has happened after the fact. I mean, no one likes a Monday morning quarterback, and they look so good, and they get a lot of followers or whatever you want to say. But being able to do it in the moment, I think, is the only thing that pays dividends.
Yeah, back on the art versus science and why 10 guys get 10 different results. I think there's three reasons for me why that would be the case. I mean, one is obviously that there's so many different indicators out there, and any and every technical analyst would weight them differently, and they all have their favorite indicators. And if that one is bullish and the nine others are neutral or bearish, then they're not going to be bearish. And number two is that, unfortunately, a lot of technical analysts do look at what's happening outside their realm, which is they look at the fundamentals and then they say, oh no, the fundamentals don't look good, so I can't be bullish. Yeah, so they take external elements into their evaluation of what they should be doing, which is clearly incorrect, but it does happen. And the third point is that, if you work for a big house and the house has a certain house view, and the house view is let's be bullish on equities, then the technical analyst may have to, although not necessarily what he should be doing, but it may well be that he takes that into account. So I think because of that, there's so many different ways how the technical analyst can come up with a view that may or may not even be consistent with what he's seeing in the charts. But still, I mean, going back to what you said in the beginning as well, is that I think nowadays it is quite possible to systematize a technical analysis based quantitative model, and whether that be profitable, I don't know. I mean, I'm not a big fan, but I'm sure there's people out there doing it.
I think that we must have, like this point, that we must have maximum clarity and consistency because of this clarity, based on this, because we must do the same things in the same situations, and it's the key, I think. So, if we see differently the situations, it's not good. And if we do breakout, it's maybe hard to see differently a breakout or something like that, or even moving averages. So clarity is the key here, and if we are not consistent, we are not systematic, not robust. So what it is?
I think you all would be fascinated by the number of interviews I did with my father, and I love my father, and he loves me, and there's nothing more that he has wanted for, I mean, decades, is to teach me, how he does it, and I've witnessed I've witnessed his success firsthand. Like, he's my dad. Like, I know what actually the truth is, and these interviews, when I'm trying to nail down, what, and he is a full on technical analyst. Like, he doesn't even know what some of these companies do, and I've just witnessed such amazing things from him, and to try and nail down these rules is like, he's like squirming in his seat. He's very uncomfortable with it, and it captivates me. But I wonder if it would be the same with all technical analysts. This is one anecdote, but I mean, there's nothing purer than the love that we have for each other. He has wanted me to be the successful technical analyst, and I mean, that's far from what I consider myself. But that's one anecdote, but I think a very pure one.
I think I can give an example of art versus science and hit on Tim's point about house view. And we see it all the time, and it's because there's a human doing this thing. They have all these external bias. It's implicit. They may have read the news with their morning coffee, and now they have taken in some information that is biasing them towards something. So the technical analyst is expressing a view, a holistic view, or a bias that he has, and then he's using the charts to confirm that thing. Now, whether that's just for sales or that's because they honestly had taken in some fundamental information and then are applying that. And that leads me to the next point of fundamental PMs, or whatever you want to call them, using technical analysis. And this is actually some place where I think it's useful. If you're trading purely fundamentals, your rate of change of information is really slow. You might need another quarter for the next earnings report, or you might need a new USDA report on crop formation or something like that. It won't change that fast, and because the information is from another field, we'll say it's not coming from the market itself, it's very hard to put together a succinct trading plan. I mean, for that specific trade. And if you already have done the legwork in the fundamental space, and then you use technical analysis to say, okay, this is my stop loss, this is my profit target, or I'm going to scale out, one third. I know a lot of people like to do that, or like some people like to campaign, or I'll re-get in here or something, and I'm going to scale into my position. It gives them points where they can do that, where a fundamental information, like knowing what the EBITDA of a company, is not going to tell you, yeah, like I really want to enter at this price. So it helps them create something that is easily executable and will reduce the human bias going forward if they're able to stick to that plan. And that art form, that Andy was talking about, I think, in his father, someone who has been doing it that long definitely has absorbed patterns of the markets by looking at charts for that long. There are patterns out there. There is something that he's doing, I'm sure, that is correlated to something we could discover in a quantitative space. And because it's innate, because it's absorbed over decades, potentially, like, he can't even explain it that well, but the human mind is such a great pattern recognition machine, and because obviously he is successful at it, he has determined what works and what doesn't, but like actually putting that down into like a formula would probably be extremely difficult, because it's been learned over different segments, so to say. Like, so all of these disparate things are kind of floating around. And then that goes back to Tim's point, where it's like, how do you weight certain things in different situations? And that is 100% some kind of implicit bias, because no one is free from either social media news or getting their Bloomberg feed or getting pinged on something to be completely neutral on everything. So there's definitely some external factor. And I don't know how I could draw something on a chart and be like, yeah, that I'm only doing that. But I do believe that there are people out there, and when I was back in the States, a lot of the old timers like to do it that way, and I do believe they were able to see things, and if they came from the floor, they understood how certain flows occurred and what certain things could happen, and they would be able to see that, and it would be something they were able to put together, and they would use this plan. So I think that's a different kind of gray area, but I do think there is some potential there.
Hi, Derek. Can you hear me okay?
Yes, Jerry.
Okay, good. I haven't been able to listen to the whole thing, so I'm not really sure what you've covered. But I would just say one thing that popped in my head was that trend following kind of is different from technical analysis, and maybe even from quant, more of a quant based, in that it just seems to be very accepting of the current failures with the current trades. Whereas maybe the technical people that are looking for these today, I need to know support, resistance, patterns. And even maybe the quants are sort of like, I can't write off this bad period or this stock sell-off. Whereas the trend followers just sit there and say, well, I'm going to go with the trend, and I'm perfectly willing to take some small losses or have this drawdown, because over a 5 or 10 or 20 year period, this type of system and signals will work out well. But right now, maybe not so much.
Yeah, that's a very good point, Jerry. I 100% agree with that. I think that the trend following, your style of trend following, and what a lot of people here do is a quantitative system, because you have that data set. unless you had been doing technical analysis trading as a portfolio manager for probably 10 years or more, you wouldn't even have a sample size that would be worth doing, because you would be need to take thousands of trades. You'd be needed to take like 10 trades a day, for 10 years or something like that. And then you would maybe have a sample size, but by then either you're good at it and you maybe got lucky or not, or sometimes inconsistency. So I 100% agree with that. It gives you this confidence, because you've done your homework, because you have the trade statistics. And I really do believe that turtle style, is a great gateway into other quantitative work, because it teaches you so many good habits. The habits of always following your system, the habits of having good sample size, the habits of being diversified, the habits of always having multiple systems, because you don't know which one is going to work. And I think that that cannot be discounted. I absolutely believe Jerry Parker is a quant.
And the one that's my favorite would be, which may not be in favor of most quants, would be don't go too far with making it too accurate and too many variables, whistles to keep you out of these fantastic trends.
Absolutely. As with any tool, it can be overdone, and overdone so much that it can become dangerous to yourself and potentially others if you're running other people's money. I think that's a very all of these golden rules are definitely something I've prescribed to, and to expand that to the technical analysis, as I'm defining this like caricature of what I believe a technical trader is. I don't think can do that. If you see so many people with so many spaghetti on their charts, a billion lines, all this shading and, so many wiggles, like I wouldn't even be able to identify some people's charts. And they have that same um, overdoing of things, of bells and whistles. And I can guarantee that they probably don't do well. It's like another heuristic I use is like, how many screens does the guy have? Like, unless you're a market maker, you don't need that many screens. You don't need to get a suntan from your trading station.
I've found, I definitely had my share of trials and tribulations, before I found my style. And the one thing that was that I learned was a trigger for myself was whenever there were one of these like situations where I hope I can articulate it, but I'm both bullish and bearish at the same time. Like I think it's gonna, for these reasons I think it'll go up, and these reasons I think it'll go down. Um, and then you see all these fake people on Twitter who are like, well, if the market goes up, I think it's gonna go up even more. If it goes down, all this. I think it's a trigger, and I think technical analysis leads to a lot of that on a short time frame, which is dangerous, right? Unlike like a longer term, trend following. On a short term, if you have a wedge, is it the false breakout, and you just have to really make sure that it's backed by rules, and very specific rules. And I think that's what quants do is to make your rules to be able to cover every possible situation. And in technical analysis, there's a lot of okay, I think it's going up, and then when it goes down, okay, I think it's going down, and you can really get chopped around. And it just has to be more than just some words saying, "Oh, I like this. I don't like this. Oh, I'm done with this stock ticker." Um, it should apply to every stock ticker. I'm sorry if I rambled.
We shouldn't forget the markets are fractal, so so it's possible to have a view on a certain time frame and conflicting on a different one. That's what, going back to Jerry, he keeps reminding us that his different subsystems have possibilities of being, long, into a trade, out of a trade, long and short because of that. But the point, the one point that I don't want to repeat myself, but I think most of the people who absolutely subscribe to technical analysis do so on an absolute basis. They think they have the indicator that follows the market, and that's, I think, where it starts failing. It starts failing because there's no one thing that can at all times offer a good synthesis of what markets are doing. All these money flows that keep sloshing around various exchanges and OTC markets. I mean, they can't be subsumed into one number, one indicator. There's a lot more structure underneath that, and I think that's where technical analysts are not willing to recognize their failure.
Yeah, I agree, and I think a lot of times it comes in the chop. There's not as much accountability. They'll this is where I will be wrong, and this is where I will flip positions, and then this is where I will be wrong on that one. I agree.
Yeah, that's very interesting because that is again, I want to put it to the failing of the human in the system to turn a trade into an investment. I mean, that's the classic mistake that these people do, and if you were to fully systematize, you wouldn't have that issue. Then, going to Bruno's point, this fracticality of the markets, I think it's obviously okay. We all love Mandelbrot and all that, but again, are those fractal time frames changing as well? So yes, one person can identify a short time trend or short time mean reversion, while another person does a long time, and they will exist at both. But like you said, how do you know when's the next time your indicators parameters are going to be good again? There might be a short period where that is the case, and then there's going to be another period where it's not the case, and then how do you adapt to that? And we as systematic traders have the same exact issue, but we have resolved it in another way because we have defined all of those entry, exit, trailing stop rules. We don't have to worry about that. We can just actually throw all of our short, medium, long time systems at the markets and let the markets sort it out, because we know from our research that in fact all of these things work well, and that when you put them together it's even better. So the human analyst probably cannot do that just because of how much mental work it would take to be able to execute. I just don't think it would be scalable.
That's right. And, I don't know if we want to go down this rabbit hole, but one question I often ask myself is whether we should change the domain in which we perceive markets and move from the time domain to the frequency domain. So measure cycles, not in terms of trading days, but in terms of swings, energy swings between a high and a low, and let that take however many days the market decides to take. So that could be a different approach. It poses many, many, many other problems. But in terms of flipping the problem around, like Charlie Munger would like to do, I think inverting, it's a useful inversion, and it's a useful exercise to go through to understand this nature of time, and parameterize, the indicators or whatever filters we use.
Yeah, I was just going to say, Derek, that I think everybody's covered a fair number of points. I'm not going to repeat that, but let me flip it around and let me ask people in this room. And have you ever sort of explained your process, explained what you do, and have the client turn around and tell you, so is that a technical system, or are you using technical analysis? And then what's your response to those kind of responses, rather, for lack of a better word?
my answer is yes. And I explain that's, even though there may be derivatives of this or some kind of correlated strategy to this, I mean, I think breakout is probably the best example because of all that extra research, because we know our sample sizes in these trade statistics, because it's systematized and there's no human in it and it can be replicated, and it is using the scientific process, as in the experiment is repeatable and it could be done by someone else who's not me, is kind of the barrier, the minimum barrier to entry. And sometimes they accept that, and sometimes it's honestly better for them to think it's technical, just because that gets them to understand it. If we're talking about a client and you need them to be on board, then maybe just having them believe that for a while before you get some additional time or a second meeting or however to get a grasp of what that should do, because it is natural for us to understand what is a trend. Like you give any Joe on the street a picture of a market that's trending and a picture of a market that's range bound, they can tell they're different. So sometimes, although it hurts my ego, but ego doesn't matter, to allow them to believe that it's okay.
Yeah, I mean, I'm trying to create a whole new genre. I'm calling it behavioral. But I mean, are there? Because I'm trying to distance myself from technical analysis. But I mean, I guess by the definition, like, of course, there's some technical analysis in there. It's just I seriously think that a whole lot of it is not for me and not accurate. So yeah, I don't want to be labeled a technical analyst, but it depends what your parameters are. Are you more technical or more fundamental? Like, yeah, I'm not fundamental at all. So it's one of those you need to drill down a definition and categories.
Yeah, so for me, I mean, I actually work as a fundamental PM. So my actual approach is very much quantitative and analytical, but that's not how it's going to get communicated to the client, because the client doesn't want to hear that. So I'm going to rephrase what my view is based on my models and indicators, and then express that in fundamental terms. And when it comes to technical analysis, it's perfectly fine to mention certain levels and 200-day breakout through the moving average or whatever, but it cannot be the main reason for doing a trade. The clients just don't want to hear that. But that's the difference between fundamental and quantitative PMs.
Yeah, I think because of all the exposure on television, it's just got divided into two groups, and probably the positioning and the way, if you're using price as a main driver in your process, people just sort of will tend to associate you with technical analysis. If you say using fundamentals, they'll sort of put you in that bucket because they don't know where to bucket quant. I mean, they've not. I mean, not a lot of quants will get invited to come on television and explain the process, because the people. I mean, there's this hilarious, not interview of this Winton Capital, David Harding, and he's trying to explain to and the CNBC folks know, it's not that they're dumb, so they're trying to ask him that, what's your view on gold, and he said, I don't have a view on gold. My system is going to tell me to go long or short, and it just goes on and on. But because it's hard sometimes for people to understand, what quantitative or a trend following system is, they will take a shortcut and sort of say, okay, it's price, it's technical, it's not price, it's fundamental. So
I 100% agree with both Tim and Anish. It has to do with this narrative aspect that we have been discussing many times over, and of course has been covered in the TTU podcast. But the idea that people take mental shortcuts, and they will need to be able to communicate this to the decision maker or regurgitate what you've explained to the investment committee. And sometimes it's okay to be placed in a pigeonhole that you don't necessarily like, if that will allow, one, the client to understand what you do, two, be comfortable with it, and three, hopefully move you along in the process. And I do think that over time they will see that you will start to diverge from that. But if it's 60% correct, it's better from them than I don't understand, I'm not going to follow up. So there is a plus and a minus to being pigeonholed, because all humans, we are all mentally lazy. If we can reduce our cognitive load on pigeonholing someone and then using our knowledge in that area to evaluate them, we're going to do that. Can I ask if anyone here actually uses technical analysis? Like, how we think of it? And if you're in the audience and you do, please raise your hand. I would like to hear your story.
I can say that I started with technical analysis 5 years ago, and I think many traders, even who come to the systematic world eventually, many probably start from charts and lines and stuff, but I wasn't doing that much of a classical technical analysis like all the spaghettis and stuff. I was still like using a few indicators like MACD, histogram, or some channels. But like 3 years ago, I started to shift more into rules-based technical analysis, and from there I started to backtest and use statistical edge and all kind of more quantitative stuff. But I actually still like to kind of validate my systematic stuff visually, so that I can understand why the strategy makes money. When I pop up and the charts and look at the charts, I understand why my rules work and what they do. So it's my work is still more like a theoretical strategies, not just empirical data that it makes money in a stable and good manner. So I don't know. I started with technical analysis, then it was kind of a mix, and I've been moving towards the systematic and quantitative, and I have still a few strategies that I haven't been able to automate systematically, and I don't trade them that much anymore. But yeah, even when I was doing more like technical analysis, I still made the rules that I had very specific rules to follow, and try to eliminate all the opinions and whatever else.
I think that's an interesting point. What was the barrier that made some of those previous technical strategies that you're not really trading anymore to become systematized? What was the hurdle that you have yet to overcome, or what was the biggest barrier there?
I think it sounds like very subjective, but it is kind of a visual, can't say a pattern, but it's a double bottom with a couple of divergences, and I believe it could theoretically be automized by software. It has been hard to do it. It kind of, my eye grasps it, and even though the entry exit everything is systemized, position sizing, the stop loss, profit target, everything, the setup of the strategy is hard to automate, because the computer and the code picks up like all kinds of double bottoms and actually the same strategy very similarly shorts double tops. So it's like not exactly the other way around, but very similar rules. But yeah, I think the computer and the code picked up like all kinds of double tops and bottoms, but my eye can kind of filter out the ones that I actually want to trade.
Yeah, I think that that's quite a common issue with some of these strategies, where there's human trying to tell a coder how to create the same thing that they're replicating, right? Because there is probably something that you've seen over and over in the market again that you haven't quite gotten the rule yet, and there's probably some times where that rule may or may not be applicable. And I found that a lot. I don't know, ages ago, when I was having to do that, coding up things for other PMs, and it became really difficult because um, my answer was that what if you are doing it inconsistently and the system is actually doing it correctly, right? There's going to be a point where the human trader is going to be making an excuse why this big loser shouldn't exist. But actually, if you were at the moment, it might have. And so as you start to approach that line, I think you have to really be real with yourself and real that like you probably might have taken this one, or like these ones are actually that. But then again, it's very hard. And if you're a junior analyst, that's not exactly something you're going to fight back very hard on.
Yeah, I've one thing that I've understood that when I was doing more like charting and then technical analysis, like the strategy I just mentioned, I had too many filters maybe also, and like too many rules. And when I've got more systematic and quantitative, I've actually removed some filters and rules, and so to also increase the trade frequency, because like I said, I don't trade these charting and technical analysis strategies that much anymore, also because of the trade frequency. Like with quantitative statistical age, I can have higher trading frequency and basically make more money. But another point in my personal experience is that when 3 years ago I started first backtesting just with visual charts and Excel, then I kind of doing it manually at first, like taught me about the backtesting, about the pitfalls, and maybe how to do it, so that before I mean, when I started to write the code in Amy Broker and TradeStation, then thanks to this manual backtesting on the charts before, I think I was more able to understand what I was actually looking for and trying to automate. So having this manual and visual experience, like I think I did it for like a year and a half manually every day for an hour or two, just to train my eye and understand what I was going to automate in the code. So I think this was actually like a beneficial experience.
You know, sometimes when I hear, I'm going to say fundamental guys or people who are using outside data, they're not able to fully articulate in a systematized way something, and it comes down to exactly what you said, Marcus. You've put this time in, your brain sees something. Over that period, I'm sure you were keeping track in Excel. You have a record of what that was, and there is something there. And then how you get that out of your brain can be extremely difficult, because you had acquired this thing over time. And I'm calling it, like, there's implicit versus like explicit learning. And if you've learned something implicitly just by like osmosis, absorbing it from experience in the market, it's a lot harder for you to crystallize that into something that can be codified, because there's probably a lot of other tangential things that you have been absorbing at the same time, and your brain is like making all of these associations. Well, if you like explicitly learn something, like, I know that this breakout strategy, whatever, this thing, that you can regurgitate that in this pure, clear form. And people who are taking in other data, you could say like balance sheet data or alternative data, traditionally would have that same problem. Or like, actually, no, this company is a value trap. Was something I used to hear a lot. Listening to other PMs, and then they give some reason, and then the next time that there's a company or thing like that, then why isn't this one a value trap? Actually, this one is value. It's not just cheap because it's supposed to be cheap, and so. When these people have absorbed this information over this time, and because they're taking in a lot of information from a lot of sources, it's very hard for them to systematize something. And then, like I said, if you were to try to backtest that for them, they would probably find a lot of positions or trades that they would not have liked. All right. Well, I guess if no one else has any comments, I'll wait for a second. Okay. Well, thank you guys for coming to this session of Quantitative Brainstorm. I appreciate everyone's feedback. It was a very diverse crowd today, coming from different angles, and I really liked Andy's and Marcus's feedback there, and Tim's perspective coming from the fundamental side of things was very enlightening. I will see you guys next week, and as always, Bruno, you have done a very good job submitting me other ideas for future episodes or future sessions. Anyone, even if you're in the crowd, you can DM me on Twitter with topics you would like to see, and then I'll put that in the weekly voting. As always, it's a democracy here, so we will always talk about what floats to the top. And if it doesn't get the first vote, normally I recycle that idea back after a few weeks and compare it to some other topics. So thank you again, and everyone have a good night.
Thanks a
Thank
lot.
you. Bye.
Thanks, bye.
Bye.